Holy smokes, thank the Lord. Oh my gosh, this morning's labor report was so good because of what was deep inside of it. Not because of the headline numbers, but what it means for the Fed rug pull. Folks, we gotta talk about this unemployment or employment report and why the market is still going to poopy doopsies. We're gonna talk about that right now in this video. And if you need any solution for your stresses, remember, just go to metkevin.com/life to make sure you sign up for life insurance you can get in as little as 5 minutes, despite the fact that we're still in a pandemic and there's a war going on. metkevin.com/life. Okay, folks, this employment report was amazing. And it, again, was not just because we had about 250,000 more jobs than expected. The Bloomberg survey had us at about 423,000 jobs, the unemployment rate falling to about 3.9%. We ended up getting about 678,000 jobs, unemployment rate falling to 3.8%. Great, fine, whatever. And most sectors gaining. I mean, almost, I don't think there was actually a negative sector here. Leisure hospitality gained the most, 179,000. Food and drinking places within that umbrella, 124K. Professional business services, 95K. 64K. Healthcare, construction, 60K. I mean, the economy is still hiring like absolute bonkers. Now, I'll tell you, this data was collected in a particular week within February, and you're going to want to know what that week is. But I'll tell you that right after I tell you this. Now, to really understand what the heck happened in February, which is the report we just got, we've got to understand what happened in January and why it was such a disaster in terms of what it could have signaled to us. So, in January, earnings went up 23 cents. This was that blue section right here, 23 cents rather, all the way up to 31.63. So these are the average hourly earnings. Now, in order to understand how much this actually went up, the correct thing to do is actually minus 23 cents here. So you end up with the old number. Now you can do a little bit of division, and it's quite simple. You just divide the current number by the old number, and then you're going to get a number that starts with 1. So I'm going to divide this, 31.63 divided by 31.4, and I get 1.00732. 1.00732. Now what we're going to do is we're going to subtract 1 from this, so we get rid of, so we just have the difference left, and then we're going to multiply the rest by 12. So we're going to subtract off 1, and then really what we're just multiplying by 12 is this here, right? So we're going to multiply 0.00732 times 12, and then we get this number that looks like this, 0.088. I'm rounding a little bit here, which is basically an annualized wage increase of, move the decimal, 8.8%. That's insane, okay? That is really, really high, especially because last month inflation was 7.5%. This means the start of a wage price spiral, which is very, very bad for that to continue, because that basically means workers have more power to demand more wages, more so than prices are actually going up, and it could start a self-sustaining cycle of inflation. The director of the University of Michigan Consumer Sentiment Survey said that we are seeing evidence of a start of a wage price spiral that is decoupling from supply chains, which means even as supply chains get better and prices go down, wages could just keep everything getting worse and worse and worse. That's like literally crisis mode, worst case scenario. The Federal Reserve will force a recession, pure FUD, pure disaster. Everything goes to heck. Very, very bad. Well, folks, guess what happened here? Average hourly earnings of all employees were 31.58. Little changed after large increases. So they stayed flat. But wait a second. This says 31.58. But wait, the last report we had said wages went up to 31.63, and going up to 31.63 was equal to an 8.8% increase. That's why we were freaking out about a potential wage price spiral. But wait a minute. Now they just went back and said, no. Wages actually last month were 31.57. We went back and revised it and changed it. And now they went up 1 cent to 31.58. Like, wait a minute. That's actually doubly good news. So what you're saying is wages did not go up to signify a wage price spiral. in February. And this is not to say we don't want people to make more money, right? It's just to say, like, in terms of an inflation aspect, this is good. Like, they're up, but they're stable. But you actually revised them down. So last month, we actually only had wage growth of about 6.6%, which is actually less than the inflation rate, which is not a signal of the wage price spiral. So not only do we have no wage growth now, but last month you took away the wage price spiral that you said there was. So you said you were wrong last month, and now you're revising the data, saying, no, never mind. Last month wasn't even that bad. Okay, like, wait a minute. This is actually really good news. This is really, really good news, because the biggest fear the Federal Reserve has, in my opinion, is the potential start of a wage price spiral where they have to force a recession, and then we have to start fighting the fears of potential stagflation. What does this now mean that the Federal Reserve could potentially do? Well, they have two options here. They could potentially be more hawkish. Maybe they could raise rates more, right, because the labor market's doing so well. But I don't think they're going to do that, because we're actually seeing wages flat. And now we're already seeing people's purchasing power go down, because we're going to get, look, we had 7.75% inflation last month, right? 6.6% was the actual annualized wage growth for last month, which means a reduction in purchasing power. This month, wages, or last month, Feb, compared to January. Anyway, Feb, wages stayed flat, which means, again, a reduction in purchasing power. So why would the Fed decide, oh, this report's going to make us go more hawkish? It likely won't. The Fed's likely going to stick with their 25 basis point hike. This report reiterates, great, we've got a stable labor market, but not one that's running away to where we have to be aggressive and try to dampen how much wages are going up. Nope, that is not a problem anymore, which is really good news, because it substantially reduces the chance of the Federal Reserve's rug pull. On top of that, you probably, if anything, are going to keep the Fed in a little bit more of a dovish direction to try to support the labor market as much as possible while trying to control overall headline inflation. And so in my opinion, that is that course of 25 basis point hikes consistently. So to me, this is actually a great news. This is a very good report. I'm very, very happy about this. But not everything is good, because unfortunately buried in this report, we find out when this survey was actually taken. And unfortunately, this survey, not that necessarily it's going to make a difference, but this survey was taken around the 12th day of the month, which was about 12 days before the Russian incursion. I'm not sure how much the Russian incursion is actually going to affect hiring, but this report does not give us any indication either, or like we certainly don't have any Russia drama, I should say, priced in to this report. So that is worth noting, that next month is when we'll actually see what impact Russia is potentially having on our jobs market. So that is an asterisk and an unknown. However, the stock market cared momentarily. In fact, if we look at the pre-market here, we could see this is the NASDAQ technology here. We had a nice little bump on the jobs report. Not much, but we definitely saw a bump here. Unfortunately, this all got sold off because of fears that Russia has taken control of a nuclear power plant. This is not like a nuclear weapons plant. It's a power plant in a specific region in Ukraine. Unfortunately, this is also that city where we saw thousands of individuals line up trucks and sandbags and tires and stand there to defend the glory of Ukraine. Well, unfortunately, that facility has been taken over by Russians. And this is leading to increased fear that potentially this war is going to drag on much longer, that Putin has no interest in negotiating a ceasefire, as we've seen in negotiations over the last day. And unfortunately, that this could continue dragging on and out, which is terrible. It is exactly why we are seeing wheat, our index here for wheat, skyrocketing. Let's go to the day chart here. Look at this. You're probably up about 50 to 70% here, which makes sense because wheat prices are up about 70% year to date, which is wild. And most of that has happened within the last 30 days, specifically because of the incursion in Ukraine, because of a substantial amount of wheat exports that come from Ukraine. Now, the wheat harvest is not actually until August. So if this crisis is over within the next month or two, and too many wheat fields were hopefully not destroyed, well, let me make sure I said that correctly. Let's hope many wheat fields weren't destroyed. Then I would expect wheat prices to plummet very, very, very quickly. So if you're short-term speculating on this, great, but just know when this turns, it's going to turn fast. So just bear that in mind. Now, it's also worth noting that some riskier plays are selling down right now. Upstart, Open Door, QQQ. Look at that, you've even got Dave & Buster's coming down 5%. SoFi kills it on earnings and just plummets here. Affirm falling, right? So there's a lot of pain in these more profitless, riskier sections. And that is normal. That is normal. This is the kind of market where I do think it's a mistake to get into the riskier profitless companies. And it's a mistake that I've made as well. I try my best to limit the mistakes that I made and recognize them when I do make the mistakes. But what I'll do is I'll do a portfolio update for everyone in a different video, and we'll take it from there. So anyway, happy to share this good news. Thanks so much for watching, and folks, we'll see you in the next one. Goodbye.